Welcome to the Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and as always, I'm here with Ross Marinell. Ross, what's up, buddy?
Michael, how you doing today?
I'm tired, not gonna lie. It's been a week. I'm a little bit drained, but always excited to get on here. And
you fell back on the clock, ready to fall back to sleep.
Yeah, daylight savings time. It did, and I've got my 3-year-old is like, he's having a whole disruptive sleep cycle this week.
He's not happy.
He's coming in the room at 3 a.m. It's you don't realize like how an unbroken night's sleep, how great that is until like you don't have one for a while, and then you're like, man, this is the best.
Well, we got some things to lift your spirits today. A couple of sort of lighthearted stories, both kind of involving Robinhood. So if you're not familiar, Robinhood is a trading platform.
Yes, it's part of fintech. Most people would be acquainted with it through, I believe, the app, the Robinhood app. It's come to the prominence through free trading, free stocks, stocks and more stocks. Get your stocks right here, Robinhood. Yeah.
So it made a couple of headlines this past few days.
Just one or two.
So let's start with one, just kind of lighthearted. I thought this was funny. So Robinhood user posted a question. He said, after making a trade, is there any grace period for returning the stock if I don't want it anymore and change my mind? And then he goes on to say, I'd probably only use this if the stock went down really quickly or if I found out something unethical about the company. Thank you. So, Mike, can you return a stock if you don't like?
Yeah, we have a 10-day return policy. If you just show us your ticker, your order confirmation number, we can return that stock.
Not to poke fun at new traders, but that certainly got a chuckle.
Disagree. It's 100% to poke fun at these folks that are in here. In case you didn't catch that quite, if I were to go down the street here to TJ Maxx and I wanted to buy myself like a hoodie that I found at TJ Maxx for a few bucks, I'd go check out, buy my hoodie. I'll have my receipt. If I decided, I don't want this hoodie, I'm going to take it back. TJ Maxx is going to have a return policy. This person posted on the Robinhood Q&A forum, how do I return my stock if I decide I don't want it?
He's only going to do that if the stock goes down or bad news about the company surfaces.
If it goes down suddenly, like a sharp decline. Oh, wait, I got a bad one. I got to turn this one back in.
I will say this. Before you risk your capital, right, your hard-earned savings in dollars,
right,
you do need to know the rules of the game.
Yeah.
So you cannot return a stock if you don't like what happens, if there's sudden price movement.
It's called you sell it back at a loss. Right. That's how you return it.
You don't get your money back.
Exactly. There's no money back guarantee here.
Okay.
Or no, the best part of that whole story was the second part of it. To me, was like if the company was caught up in something that was unethical, like we're gonna have a protest. I'm gonna protest by returning my stock to you.
That's right. Okay, so trade at your own risk. One other Robinhood story this week. This was a shocking headline.
This was the best.
So I found a nice summary of this on Yahoo Finance, dubbed the infinite money cheat code by users of Reddit's Wall Street Bets forum. Robinhood had a bug that was being exploited by a few users there that was allowing them to leverage small deposits into really sizable balances,
right.
In some cases 20, 25 times leveraged, to then go and then, basically they were making trades.
Right.
In other words, kind of on what we would call margin, borrowing,
right,
to make bets. But in this case, this was clearly a glitch in Robinhood's system because they would never allow people. In some cases, a $2,000 deposit was leveraged to $50,000 in buying power.
Right. So for those listening, we actually saw a live video of this where a person had deposited just slightly over $2,000, but with that $2,000, they were controlling over $50,000 in securities.
So just to wind the story out a little bit, so this gentleman was apparently buying Apple puts. So that's an option on the hope that the stock would decline in price.
Worst stock ever to probably put puts on. I'm just saying.
Well,
that's not a recommendation, but my personal belief is, if I'm going to get puts on something, it's probably not going to be Apple.
So at 9:29 in the morning, before the market opened, it looks like he had a little over $57,000 or so in an account balance. Mm-hmm. And as soon as the market opened that day and Apple was trading higher, he pretty much lost. I think it was about $50,000.
Oh,
we'll post a link to the YouTube video. You can check it out and think about what you will.
I think it's hilarious. I'm heartless when it comes to that, but listen. We live in the information age. You got a lot of people online that are extremely smart people, extremely intelligent, but you also have a lot of people on there that are pump faking everybody, with their newfound knowledge on, trading algorithms and chart watching and this technique and that technique, and they're all on there going back and forth, and you don't know who these people are, like what they're up to, what they're doing. And now we're going to start seeing it. We're going to start seeing some of these things. And I shudder. I shudder to think like what kind of dragons were going to come out of the woodworks the next big downturn.
Well,
when people just get slaughtered.
Well, even with the blowback from this little glitch, a few users exploiting, this to leverage their accounts, tens of thousands of dollars, if not more. Who's going to be on the hook for these losses? Is Robinhood going to forgive these users for taking advantage of a glitch? Are they going to end up owing?
We had a spirited debate about
dollars back. Could they owe interest on it? Robinhood has margin. They have a way through their option trading platform that you can borrow money to invest in securities, but they do have interest fees on those. So it'll be interesting to see how this winds out if these users that took advantage of this code, the infinite money cheat code, as
infinite
it was
money
known
cheat
on
code,
Reddit.
That could be a T-shirt one day. It's a amazing slogan. But just real quick to wrap that up, I took the stance on that I think they will. I think these kids, and I say kids, who knows who they are, but I think they're going to have to pay this money back.
We're going to find out.
We're about to find out.
Oh, but the risk taking, boy, they're brave.
Is it bravery? Is it just stupidity?
It's insane.
Yeah, I think it's insane. I don't think it's bravery. I think it's they're literally, they found this glitch and they're at the casino, and potentially playing with house money.
Just think, if you, in a traditional margin account, a broker lends the investor cash to purchase stocks, other securities, whatever it might be, but that's collateralized against your current, stock,
what you own,
securities and cash positions, and so it's not that indifferent than borrowing, anything really, right? There's collateral,
you can get burnt, but there's a system to it.
My point was, even a traditional above board margin account still introduces additional risk because you are borrowing money to buy securities, and if you lose money on your investments, then it's a cascading effect. If you're leveraging 25, 50 times what you have,
leverage goes
you're
both
in
ways.
Outer space. You're not even in. There's no loan
50x levered. But hey, that kid he'll probably be running a hedge fund one day.
Just
because that's how they roll.
I don't stay away. I'm going to stay away. All right.
Launching the Robinhood Hedge Fund X series is this kid.
What else you got?
Oh man, well, I saw this article a couple weeks ago, and it caught my attention. It wasn't very easy to read, but I thought because when I clicked on it, normally things like pop up. It's like a top 10 or whatever. It didn't really pop up, so I had a hard time looking at it, and it kind of went out of sight, out of mind for me. But it was an article on Think Advisor. Published back on October 30th, and it said the 10 scariest retirement statistics 2019.
Okay.
And I won't go through all 10 of these, but there were several that I thought that were more interesting. There's some time-tested wisdom in here, like, hey, don't people spend people who spend more than their income tend not to do well. Well, that's we've beaten that over the head, I think, many times. Mm-hmm. But there were a few here I'll point out. Number 10 was, according to Experian, baby boomers have the second highest student loan balances. So as of the first quarter of 2019, those balances averaged $34,703, and they rose by 7% over the previous year. Only second to the only cohort that has more than boomers is Gen X, which is that the average loan is $39,584. I thought that was a bit crazy, but we have spoken to folks that are baby boomers that they sign student loans or they co-sign on loans, and if you co-sign on a loan, student loan, or you do a Parent Plus loan, I mean, you're on the hook for that.
So to define, a Parent Plus loan is a way that a parent can help close the cost of attendance for one of their children. So remember, there's for a student to borrow from the federal government, there are maximums that they can borrow each year that are pretty low, around $7,000 a year, just give or take, right? Well, we know if you're at a college that costs $30,000 a year and you can only borrow, let's say, $7,000, well, there's $23,000 in cost that is left. And if you can't fill that through just pay as you go, sort of working, or just cash, build it into your income plan, then you have to borrow, right? Mm-hmm. So what's happened is, I'm sure, the right spirit, right? The parents have came in and said, well, we will help borrow. And there is a way through the federal loan program to borrow what's called a Parent Plus loan. That the student is not signing on that loan.
No.
That is exclusively the responsibility of the parent. And when are they doing that? Well, if your children are in their, late teens, early 20s, you might be in your 50s and find yourself approaching retirement, still servicing student loan debt from now, hopefully, what is your grown and educated children. Their life is moving forward. Hopefully they're working, they have a great job, but you are about to retire, conceivably, you are servicing student loan debt.
Yeah, so that was interesting, and it made me think about this other point on here. Another one of the top 10. It says was retirement plans for 80% of Americans keep working, and how we've heard this so many times. According to the Employee Benefit Research Institute's 2019 Retirement Confidence Survey, 80% of workers think that they will be able to work for pay in retirement, yet only 28% of retirees report that they have actually done this. Planning on work that just vanishes like a ghost after retirement will haunt you if you don't have Plan B. Obviously, they got some Halloween wording in here, but we've talked about this before. The early unplanned retirement, how a lot of people, they're planning to work to a certain age and they have to retire early for unplanned reasons, health or something else happens. This is talking about people who think like, hey, I'm going to retire full time from my job that's stressing me out, but I'm still going to work. I'm going to go find me some work, or I'm going to do some consulting. And this is saying that a lot of those people that have those plans don't always materialize. In fact, it says only 28% of retirees report that they have actually done that. So that could be a huge game-changing experience for someone. If your whole plan is centered around, I'm going to go work somewhere else, or I'm going to retire and have some income from working, and not be able to do that.
Right. So we always want to encourage people to have their retirement plan within their control. And that
or
means
at least control what we can
control what you can control, and you kind of get to hit the eject button when you prefer. The challenge is if your retirement plan is to continue working, that's a two-way street. You also have to have an employer that's willing to employ you, and that will continue to employ you as long as you want to work. And what we're seeing on occasion is that that's not necessarily happening, right? And I think your statistics back that up. So a well-intentioned person may want to continue working into their 70s or longer, and that might be their intent, but they have to find employment that will actually allow that to happen. And the challenge with the unplanned retirement, so being let go from your employment before you want, the challenge is it pulls everything ahead of schedule, right? In some cases, it may pull Social Security benefits, a claiming date ahead of where you want to claim.
Right.
You have to start living on your savings before you preferred. There could be health insurance coverage issues. It just everything spirals into a more challenging atmosphere.
And I think that's one of the things that is probably resulting from this 401k cohort, if you will. A lot of these baby boomers are the first ones to have to deal with 401ks versus a pension. They were the ones responsible for socking their money away. And, to the average person walking around, and I'm not going to throw out a number because I don't want to prescribe a number that, may or may not make sense. But a lot of folks look at their 401k balance and whatever they see on there, a good portion of them think that that's a lot of money. If you just look at it in sum of it's a healthy balance. But if you start trying to think about, well, what kind of income that number can actually produce for you in retirement, that math changes significantly, and so that's one of the things that, we want people to understand is, don't underestimate the value of your human capital of, working 1 or 2 extra years, even if, you're kind of done with it, but, working that extra 1 to 2 years could sometimes be a lifesaver for your overall retirement income plan. And then for our younger families that are working, we can't stress enough, find a way to be as prudent with your dollars, your cash flow as you can. If it's getting rid of high interest bearing debt, getting rid of credit card debt, student loan debt, or trying to stretch a little bit and get a little extra money socked away in a retirement plan, or maximizing an HSA, whatever you can be doing to be thinking about your future, 15, 20 years from now. It's hard to think about that because it feels like it's so far away, but the way life works, we're going to wake up one day and be 50 and 55, and you can see the horizon right there, and you're going to feel like, oh my gosh, either I'm not close to being ready, or you're going to feel like, well, this is hopeless. What else am I going to do? And we don't want you to do that. So it's important to be looking at, I always experience can be the best teacher sometimes. So look at what those folks are dealing with now, that are 5 years, 10 years, 15, 20 years ahead of you. What challenges are they facing, and reverse engineer that. How did they get there? Right? Did they, refinance the house and refinance the house and refinance the house, or what mistakes were made, and how can we avoid that?
Sure. What other risks stood out to you from the report?
There were several, but most of them were kind of, there was one on here about, how bad financial literacy is for folks. We kind of understand that. Spending more than one's income is begging for trouble. We know that. I think the other one that probably, this may reflect more about me personally, but it said number 4 was 1/5 of Americans, 21% of Americans don't save. It says that means there's nothing. That's according to Bankrate. There's a source quoted on the article. It says that means there's nothing available, not just for retirement, but for any financial emergency, health, car, you name it, may come along. So to me, it may not be politically correct to say something, but when you have this cohort, of your society that either for whatever reason they're not saving or they can't save, right? There are programs that we have to try to help take care of them. There's medical programs to try to help give them health care. their Social Security. This one of the reasons Social Security was actually put into place was to be social insurance for people so they wouldn't be destitute. And, as our country is very wealthy as a nation, as the, kind of the standard of living continues to rise, there's this debate about fairness and like what's fair and what's not fair. And if you have a larger and larger growing percentage of people not saving or not putting money away, those programs are going to be under financial strain. So that results in what? Probably higher taxes, or how do we pay for those programs? So that plays into folks like, how are you preparing to handle your taxes in retirement? What are you doing to be proactive in that area?
We just need Robinhood's infinite money cheat code to be more widely accepted.
So Robinhood is the Federal Reserve's app for stock trading. Is that what you just said? Hey, we've got, QE Infinity.
So I had one thing that popped up this week that I wanted to chat about. So this was a take from a gentleman named Jonathan Clements that posted some pretty interesting stuff. And so he had a statement. He said, cash value life insurance accounted for 60% of new policies sold to individuals in 2018 versus 40% for term insurance. So this was from a study done by the American Council of Life Insurers.
Right.
This is, I think it was posted just in October, and it kind of summarizes the 2018 sale of life insurance. And one of the things that is still surprising is how much of the life insurance that's bought and sold each year is still cash value. There's been it seems that the popularity of term insurance, the idea of, buy term, invest the rest, get a higher, life insurance benefit for your family. If something happens to you, pay a little bit lower cost now, and know that over time, that term is going to eventually or hopefully arrive, right? Where the term expires. So it's not a permanent policy. So there is some risk to that. But for most families, I would imagine that making sure they had a sufficient term insurance coverage would be one of the first things that you would see a family do. And it's surprising to me that so much of it is still cash value.
Yeah, I think without reading the study and the article, my take on that is probably there is a lack of true financial planning that's happening. It sounds more like a product-centric approach where, there are a lot of folks that work in this business that really believe wholeheartedly in cash value life insurance. And I know many people personally that have some phenomenal stories of how life insurance, sometimes specifically cash value life insurance, was a game changer for them or their family or somebody they know. So I think every product like that, can have a place at the table from time to time. But the fact that there's a that large of a discrepancy when we know that you can buy so much more coverage, for pennies on the dollar using term coverage. And generally speaking, a lot of people aren't insured. They don't have enough life insurance. So how this is outpacing term is a little bit baffling. It sounds like at face value, you have a lot of folks that are buying the story, like the sizzle and all the hype about what the cash value life insurance might do or could possibly do. And it's being presented as this Swiss Army knife solution to all your problems from a financial planning standpoint.
Right. So the cash value life insurance story is basically overfund a policy, a permanent policy, allow it to have some growth potential, build what I would hope to become a sizable cash balance in there, and then you borrow against the policy. And that's the story in a nutshell.
That's one of it. I mean,
15-second story.
I think the core thing is, buying insurance isn't fun. I mean, it's not sexy. I mean, it's not something that we're like, man, you know what I get to do today? I get to write my insurance premium check today. No one feels good about that. No one's getting the little hit of dopamine like they are on their Robinhood app with their, QE, leverage to infinity.
Puts.
right, when they were buying insurance. And so it's not something that a lot of people like to talk about, much less actually do. So, but what cash value life insurance can be presented as is like, well, look, it's a permanent policy, but your money's not lost, right? It's going to build a cash value over time that you can pull money out, you can borrow against. Eventually, if you decide down the road you don't want to have the policy, some of the cash value could act as like a refund of premium. All these, there's so many different ways that it can be spun. And, like I said, there are plenty of situations where cash value life insurance should be part of the conversation, no question.
Well, look, I would just say,
but the degree that statistic shows the separation
it's nuts.
of
Because what we just talked about 5 minutes ago is we have an issue with we have a lack of savings, right? So think about if we are not saving substantially while in our working years, 20s, 30s, 40s,
Sure.
50s. If, God forbid, something is to happen to you and your family is going to carry on without you and your lost income, you probably want maximum life insurance benefit for the family. And that would likely come through purchasing a term insurance policy that has a lower cost, which is a little bit more affordable with more life insurance benefit. Because ultimately the goal would be to protect your family in the event that you're not there to support them through your earning.
Right.
The cash value life insurance story is, let's build a retirement benefit that you can then borrow from tax-free. Maybe that's 10, 20, 30, 40 years down the road.
Sure.
And the issue, again, is if we're not saving enough right now during our working years, what happens to the surviving family if we don't have adequate coverage?
Yeah. Well, I see, and then on kind of to flip that around, I think a lot of wealthier individuals do leverage cash value life insurance because they need tax deferral, they need ways to sock away money. But for your your up and coming family with small children, what they need more is they need larger death benefit. That
Right.
they don't need this cash value building pot. They need like maximum death benefit because if primary heaven help us, but if primary breadwinner parent got hit by a bus tomorrow, how many years of lost income, college education, all these financial goals that haven't been funded yet, do we need the insurance to replace?
Look, if you have a sufficient emergency fund, if you're maximizing your employer retirement accounts, if you've got your debt under control, and then you have additional dollars that you want to invest, okay, maybe you would consider something like that. But it should be one of the lowest things on the totem pole.
It should be leading the charge,
and it shouldn't. And I doubt 60% of the people are really hitting that metric.
So we have a couple minutes left here. I want to throw this out from the Twitterverse. Peter Mallouk, who is a CEO of Creative Planning. I believe that's his title. Peter is a neat guy, but he tweeted out, most people aren't noticing, but the U.S. is going private. In 2000, there were over 6,000. So in the year 2000, there were over 6,000 publicly traded companies. Today, there are less than 4,000. So in year 2000, there were about 1,500 companies backed by private equity. Today, there are over 8,000 backed by private equity. His source on that is WDI. So what do you think about that? I think that when you see the debacle that is WeWork and some of these other things,
I was just looking at
it makes you wonder the quality of some of these companies that are backed by private equity.
Who can go public? That would be my question.
That's another way of looking at it.
Look at just the results. We went through this a few podcasts ago. Just the IPO market this year, it was just riddled with companies that are getting their valuations smacked around a little bit.
It's still happening.
And if the growth model doesn't change, if these private companies aren't looking at what we consider, I think the average person would consider a business.
Mm-hmm.
You provide a service, a value, you get compensated for that. You earn an income. That income supports your family, your employees.
Right.
You invest that money back into your local economy. That's kind of what we expect. But that's not really what's happening in some of these private equity firms. They're growing at all costs. And that means they might be burning capital, but they're taking market share, but they're not producing a profit necessarily.
Do you think this is a byproduct of the super low interest rates where capital is just cheap to borrow and lever up and invest in these companies and shoot for the moon?
Or just in general, a lack of patience.
Yeah.
everybody, if the idea is we need to grow X% every year, year over year over year, and we can't be mindful of our balance sheet.
We got to grow before they figure out what they got to go. We got to get out of here before they figure out that there's nothing happening. You know.
Well, they may
no
remain
one.
private.
There's no one home.
If the public market doesn't want to invest, then there could be a good reason why there's more private entities now than there were,
Well, I think that
19 years ago.
It'll be interesting to see, but I've heard this talked about as how, companies, there are fewer publicly traded companies, but what it was going to be interesting is to see if the balance to that would be some of these emerging markets and these other countries that are building their infrastructure and having significant resources invested in their growth. If we don't start seeing some innovation and some companies come out of there that create some real growth opportunities. So that'll be definitely something to watch in the years ahead. But as always, man, this is a fun conversation. I'll never forget, what do we say, the free money cheat code?
Free money cheat code, infinite money.
If you have any questions or topics you want us to talk about on the show, give us an email. Shoot us an email over at themoneyhuddle@vcplanning.com. Our email address again is themoneyhuddle@vcplanning.com. And we will talk to you next time.